Hello, good evening, welcome to Upfront. My name is Raymond Aqua. As I speak to you now, the #1 trend in Ghana is hashtag over to you, Bawumia. This is clearly connected to the city's recent performance. Now, the rate of depreciation from January to date is 4.88%. The same period last year, there was an appreciation, which was 1.52%. So, its actual value was 4.54% as of January 2018 and reached in early February, somewhere around 4.47. Now, as I speak to you now, the cedi is at 5.24%. Plus, I mean, there's the rate of depreciation. What's really causing the current cedi's woes? That's the crux of our conversation. And indeed, what's within this hashtag that's making a lot of wave, that's suggesting that some way, somewhat, the Vice President of the People's Republic of Ghana is connected to the current state of the city. After the break, we'll explore all of these. You're welcome back. This is Upfront. My name is Raymond Aqua. And this evening, my guest is from the Finance Committee of Parliament, a very vociferous person, especially when it comes to our finance, and the government of this republic is managing the economy. John Abol. You're welcome, sir. Isaac Adongo.
Yeah. Thank you.
I hope you're doing well, sir.
I'm doing good. And you?
Yes, I'm doing well. I can say but what seems not to be doing so well is the Ghanaian currency.
Yeah.
And the signals it's sending, at least if you compare to last year, at the same period last year, the cedi was somewhat appreciating minimally 1.52%. But it's not the same as we speak. Yesterday, we've heard from people who are into importing, who are worried about how they are losing huge sums of money through this particular process. First and foremost, is this, as they say, cyclical, or something really wrong is happening in the economy?
Well, good evening to your listeners and to yourself. I think, there are cyclical performances of a currency. But you have just alluded to the fact that if we were to follow the cyclical, we should be seeing an appreciation because we are in the same period last year compared to last year. And if last year it appreciated, we shouldn't be talking about depreciation now. We should be talking about appreciation. So that should tell you there's something fundamentally wrong with the economy and whatever support the city needs. And I feel that the reason His Excellency, the former president, is trending is because he said we should look to the fundamentals of the economy if we want to understand we should look to the city, the performance of the city, if we want to understand the fundamentals of the economy. And to him, when the fundamentals are weak, the city doesn't perform. And if the fundamentals are strong, then the city does perform. And so people are now asking, at 5.24, and to be honest with you, at 5.24, if we want to use Dr. Bawumia's own formula for calculating depreciation, which is the rate of change, which even though nobody uses it except Bawumia alone, the rate of change calculation of the depreciation of the city at 5.24 will give you about 5% depreciation in just 6 weeks. Yeah. That is alarming. 6 weeks. We should be seeing this somewhere around September, but we are seeing it right now. And that should be very, very worrying. Why are we where we are? And I'm saying that it is all because there are a number of issues. One is the fact that the city's main woes today is essentially in response to acute shortage of dollars in the system. It's as simple as that. The dollars are simply unavailable. The Bank of Ghana has very low net international reserves to support the city. And that is creating further uncertainties because when your net international reserves is that low, what it means is that you now face a lot of external vulnerabilities. If there's the slightest hit to your imports, and you need to all of a sudden find the dollars, it will be difficult for you to find the dollars to support the system. And so that is one of the main reasons. But what is creating the problem of the shortage and what is creating this low, reserves? Essentially, what investors are doing now is that they are pulling away their monies from Ghana. So investors who put their monies into government bonds, ordinarily when those bonds mature, what they do is that they have accounts in banks in Ghana here. They just put their monies there and they look for the next opportunity to reinvest that money. So the money doesn't leave the country. And now, they are now not reinvesting, but they are taking the monies out.
Oh,
now, if they are taking the monies out, they won't take the monies out in cities. They will look for dollars to buy. So that is an additional demand that you have to manage. And the challenge of that, and that is why right from 2018 to now, we've been talking about portfolio flow reversals. And these reversals are significant. And in simple language, it is the fact that investors in government bonds are not reinvesting their monies, but they are taking their monies away. Okay. Now, another challenge that we are also having is that ordinarily when government of Ghana decide to issue bonds, okay, and raise money, what the international investors do is that they bring the dollars from wherever they are into their bank accounts in Ghana here. And then they will then buy the cedis. They will then convert those dollars to cedis in their banks and use those cedis to buy the bonds, because the bonds are normally locally cedi denominated. So when they now buy the bonds, what happens to the dollars that are sitting in the bank? It increases the liquidity or the supply of the dollars in the system. Mm-hmm. Today, they are not buying the bonds. So if they are not buying, what it means is that the banks in January, how much they were getting from investors who were bringing money to buy bonds and were converting into cedis and leaving the dollars in the bank for the banks to then supply to importers, those monies are not coming. And I want to give you very simple. In January, just January alone, the government went out to raise an amount of 4.15 billion Ghana cedis. You know how much they got? They got 1.3 billion. Mm-hmm. 2.8 billion could not be realized. Now, that 2.8 billion is the foreign investors who have brought the equivalent of that in dollars and then exchange those dollars into cedis to buy the bond.
Okay.
And therefore, the banks would have had these equivalent of dollars sitting in their account to be able to then lend to people, sell to people who want to import and need the dollars. Are you getting the point?
I get your point.
We are getting very serious crisis, and it is all because the Bank of Ghana is consistently deceiving us that it is cutting the policy rate. And when you cut the policy rate and your interest rate is low, the foreign investors are saying, look, I get more from investing in the US. Yeah. Because in the US, I'm investing in dollars, and I'm getting a certain interest rate that is good for me. And when I realize my investment in the US, I realize them in dollars. In Ghana, I bring my cedis to come and buy, I bring my dollars to come and buy cedis, okay? And then I invest in cedis. When I want to take my money, by the time I take my interest and I take my, my principal, and I want to go back to my dollars, I need more returns in order to be able to buy back the equivalent of dollars and still make some amount of money on it before I can take it home. So
this is not only a contributor, main contributor.
It's a major
contributor.
It's compounding the problem. So last year, what we call the uncovered auctions, which is basically the shortfall in what government wants to borrow and what the people are giving, was in the region of 5 billion. That is people refusing to buy government bonds. But in terms of people who were also disinvesting, that is when their bonds mature and they decide they take their money, they don't look to reinvest the money in government bonds, they take them out. If you add all of that, we are looking at something in the region of 8 to 9 billion. That is huge.
But I read a recent financial sector report by the World Bank, which is saying that risk-averse investors are not investing in developing countries, including Ghana.
Yes.
Is this peculiar to Ghana?
It is in an emerging market. So what do you do? Yeah. What you do is that you create an attractive interest rate. And the attractive interest rate is that you need to now up your interest rate in order to attract investors. When they compare you to the other markets, they will come here. Here we are being told that we are cutting it. I mean, can you see the inconsistency and policy distortion? All because we think that when you cut the policy rate, you are giving an indication that the economy is good. But the economy is not good. That is the point I'm trying to make. Now, the other challenge of all of this is the fact that if you look at Ghana's own import bill today, there is a very worrying underlying factor that is creating a problem for the city. Before the NDC left office, okay, our imports were significantly in favor of import of capital and intermediate goods. Capital goods come in to retool our factories and set up factories and expand the productive sector. So we produce locally, okay? Then we also have the intermediate goods, which was doing very well. So we import a lot of raw materials, we import a lot of things that the factories need in order to expand production, even in the midst of doom so. When MPP came now, do you know what is happening? For 2 years consistently, our import of capital goods is declining for 2 years consistently. Our import of intermediate goods is declining. But you know what? Our import of consumption final goods is rising.
Okay, now let me be clear. I read a report that said that on external sector developments, Ghana in 2018 recorded total capital goods import of $2,000 US dollars and over 2,570 consumption imports, out of which some 339 million US dollars was spent on rice importation. And
where are you reading this report? Let me give you some numbers.
Okay. Yes, I'll come to that. I'm talking about, I mean, this is also from the Bank of Ghana.
Yes.
Yes.
As at when?
No, of course, this is just January this year.
Yes.
Yeah.
Now, let me give you some numbers.
Yes, I was going to support that with the MPC, the Monetary Policy Committee.
But don't listen to the MPC anymore. Because
really?
Listen, you want me to tell you why?
Yes.
Have you looked at the MPC report? Have you compared it to the macroeconomic data they released at the time they were issuing the report? And you will see that the numbers they are reporting in the MPC are the numbers in the macroeconomic indicators. That's why I wrote to them.
Okay.
And recently, have you seen that recently, after they received my letter, they have actually gone there to alter some of the numbers. So, and you want me, do you know what the Bank of Ghana is telling you now? That the exchange rate for the cedi is now 4.95 and 98.
Yeah.
As of today.
That's what they're
Will you rely on that Bank of Ghana? Because if you rely on that, and you budget that the dollar is 4.98, and you wait for the next 5 days and you go to buy the dollar at 5.4, will the Bank of Ghana give you the difference to be able to buy the dollars?
No, not at all.
So why would you be relying on a Bank of Ghana that's not telling the truth? So let me tell you, goods, capital imports, 2016 is $2.2 billion. 2017, 2.6 billion. And 2018, 1.9 billion. That is a complete decline, consistently. Intermediate goods, 2016, we have 5.8 billion. It declined to 5.2 billion and 5.1 billion. Now look at consumption imports. 2.1 billion in 2016, it increased to 2.4 billion in 2017. It increased further to 2.6 billion in 2018. So we are substituting the import of capital and intermediate goods that will expand our economy to buy into toothpicks. Okay, so people are now looking for more money to buy finished goods, and the dollar just doesn't exist.
Okay.
So if you have an alarming slide in the structure of our imports, okay, and this was when we were having doomsday and manufacturing companies were even struggling, they were importing more. Now that we are claiming that there is stability of energy, and you expect us to expand the productive sector, that is the time we are collapsing the productive sector, and we are rather importing the final goods to substitute what we would have been producing. And you expect that the dollar will be strong? Definitely the dollar will weaken. And these are
the implications of this for even the Plenty for Food and Jobs program.
So it's also it's all English. It's all English. The numbers just don't speak to that. The numbers just don't speak to that. So you have a situation where, because of the nature of our non-oil imports into the country, we are eliminating the capacity to be self-sufficient and to conserve foreign currency. And we are rather favoring exporting jobs. And you see, this is more hurting because His Excellency Dr. Bawumia said that they will be reducing and removing duty on import of intermediate goods. You don't know that?
Yes.
What has happened? So this is a very, very bad fiscal policy, which is creating a loop-sided import of goods and services. And that is creating a major problem. And
this conversation has been a very long-standing conversation. What could have government done in the interim on this particular issue?
This is not a long conversation. This is 2016 to 2018. I
get you.
So if 2016 was worse, yes, we seek to improve it. But it is worse. So it is not a new conversation, an old conversation. Yes.
No, I'm saying that
if you have a fiscal, if you have a fiscal policy, if you have a fiscal policy that discriminates in favor of consumption goods, what do you think will happen? You remember that recently when they came and said they were moving from taxation to production, the first thing they removed was the intermediate goods. They didn't. They left intermediate goods. Did they remove taxes on capital goods? No. But they removed taxes on consumption goods. And everybody was cheering, hey, right? Then after that, they then said, when you now import it, we will make it easier for you to sell by making sure that in the distributive trade, we provide a flat rate of VAT. You didn't hear that?
Yeah.
So that's a policy distortion. So this is the end result. The end result is that whereas the NDC was living and building an economy based on internal capacity to produce and eliminating and reducing import of final goods, we are now back to square one.
Now,
and you expect the city to perform.
So you made first mention of investors taking out their money.
Yes.
You also made mention of our current state when it comes to
Yes.
international reserves.
Yes.
And of course, I mean, consistently, government references gross international reserves.
No, we don't
There's
use
very little reference to the net international reserves.
No, and I'm
in
not
this
telling you
particular
why.
case.
You see, in the gross international reserves, the monies that are sitting there are not for you.
Yeah,
They are not for you. They are not for Bank of Ghana. So Bank of Ghana cannot take anybody in Ghana's money, okay, to go and intervene in the market. What the Bank of Ghana can use to intervene in the market is the foreign currencies in its possession, where we have removed all monies that are not yours, all monies that are encumbered that you can't have access to. Okay? So what is now left is what you, Bank of Ghana, can dip your hand in to support the market. And that is decline. Do you know the Bank of Ghana spent 1.3 billion just to support the city in 1 year?
Last year?
Yeah, just last year. In 2017, they spent 1.2 billion.
I mean, I know they pumped in some money, but 1.2 billion.
In 2 years, the Bank of Ghana has spent 2.5 billion to support the city. Is that sustainable? That is obviously not sustainable. And the window of opportunity to generate a lot of liquidity in the system and build your own reserves, you are playing politics with it. Are you getting the point?
I get your point.
This is going to get worse after April when the IMF exit Ghana. Because of IMF's exit, there are already uncertainties. And those uncertainties are going to worsen after April. And if in January we are already seeing a 5% depreciation of the cedi, then God save us. And this is the kind of policies that are incoherent in terms of what monetary policy should be achieving. And that is why I asked the question. Why are you, if you look at the growth numbers, the real sector of the economy minus oil has consistently declined since MPP came. The real sector. Forget about oil pushing the growth. But the non-oil sector has not registered the 5% that was registered in 2016.
Are you using rebase figures or the...
Whatever figures you use,
rebase, okay.
whatever figures you use, it was 5% in 2016, okay? And we are yet, 2017, we achieved 4.8. This year, we achieve another 4.9. We are yet not even up to 5%. Now, if your policy decision is to be cutting policy rate to boost the economy, okay, which sector of the economy are you targeting? Oil production will not increase because you have reduced policy rate. The only sector that will respond is the real sector that will have cheaper credit. Are you getting the point?
Yeah,
but if that real sector is still declining, then it means that that policy is not potent. And yet, one sector that will help you is boosting the flow of international reserves into your country by foreign investors. Now, you are cutting policy rate to support a sector that will not respond. But the sector that is responding very sharp, you are disadvantaging that sector. And that sector is now depleting your reserves. It is now making sure that you don't have liquidity in the market. And as a result, there's pressure on your currency.
So, you see, sometimes financial language makes some people don't get us.
Yeah.
What you're basically saying is that investors will deliberately invest in your markets. And when they have higher rates that they have to benefit from,
they will move their money there.
Yes. And you're not the only market that's looking for investors.
Exactly.
Our current rates are not attracting them.
Yes.
They're actually moving the money to different countries.
With better... And when you are calling them, they are not even coming. So those that have left, when they get when you pay them their interest and their investment mature, instead of rolling
the money
back
to dollars,
they now return the money into dollars
and take it away.
And they escape with it. Where do they get those dollars from? One, you are not getting the people to bring in the dollars. So you're already having problems of liquidity in the market or supply of the currency in the market. The few that are left are also chasing after that few dollars that you have
to be taken out.
When ordinarily they would have reinvested and not go to take that money or the dollars. Then you are also encouraging a structure that relies on import of finished goods. So you yourself, you don't even import the things that produce the things that the people need, so that they will buy the local things and not look for dollars to go and import. Do you get the point?
I get
But
you.
now you are encouraging people to be importing finished goods because you yourself, you haven't produced them. I mean, can you imagine this structure? And that is the man who spoke a lot about the structure of the Ghanaian economy. And so now you see the central bank, when it is publishing data, it is jittery about its reserves. It is jittery about it. And then it tries to cook numbers. You see, I have no personal issue with the governor of the central bank. But I am worried about...
But you've taken him on a few times.
But I don't have to have a personal issue with him to take him on. I've taken him on account of public interest, on account of the credibility of that institution that must be safeguarded. Because if the IMF gets to find out that we are underreporting and we are manipulating data, do you know what that will do to our country? And that is exactly what I'm working against. Why don't you report the thing as it is? And when they now write to you, you won't respond. You go and get some people to write theory. Then you Nicodemously go into your system and change numbers again. Without explaining to the public why you have now gone back to change your original data. I mean, how can we live in a country? And then everybody knows that the dollar is wayward. Then you come and tell us that it is 4.98. And you think that you have credibility? Because I just went into a bank and saw the rate there. And the rate is 5.2.
It's pretty clear. I mean,
and you are reporting that it is 4.98. And it's published. You are eroding the little confidence that the Ghanaians have in such a major institution like the Bank of Ghana. And I feel very worried.
It's possible that it's about criteria. It's about...
What is criteria?
They sometimes say it's a weighted average of interbank rates. And that is what I've seen.
So which bank's rate will... Okay, 5.2. So which bank rate will be roaming around 4% to bring the weight down to
frankly, I don't know which one.
Exactly. So if you are doing weighted average, you see, if you are doing weighted average,
we have gone to some of these banks. And
exactly.
We've seen the figures too.
The Bank of Ghana governor should tell us the last time he bought a dollar for 5.98, 4.98. It just doesn't exist. I mean, something as basic as daylight, you are still lying about it. And that is my problem. It creates a major credibility crisis. But my biggest fear is that, you see, we have had credibility from the IMF. Mm-hmm. The reason why people were having confidence in the economy is from the IMF. The exit of the IMF is creating the fear that we may not be able to handle these things. Do you get it? The international community is already having uncertainties. Then they get to realize that we are now cooking numbers. We are cooking numbers to let us look good. Look, you have read the Petroleum Revenue Fund Act.
Yeah.
Eh?
Yeah.
Even the Minister of Finance, before he can touch the stabilization fund, unless he capped it at the time of the budget.
Yeah.
If he didn't, and in the course of the year he wants to touch it, there must be an emergency.
Yeah.
He must first come to the, what do you call it? He must first come to the finance committee, get an approval, move the money into the contingent fund. Do you know the restrictions on the contingent fund? Mm. Do you know? And that is not Bank of Ghana, because that Bank of Ghana doesn't own the petroleum fund.
That's true.
It is the Minister of Finance and the government. They will have to go through sweat to even touch it. The Heritage Fund is supposed to be there for the next 15 years from 2011 before we can even review it. So even to be able to touch the Heritage Fund, you must come and amend the law. Are you getting the point? And you have added it to your reserves. And when I ask you, how can you add something that is not yours to your reserve? You don't answer. Are you getting the point? So you are painting, and the IMF is very clear on how to account for incumbent funds. So I'm saying that the cedi depreciation issue is a reflection of, one, poor fiscal management, which is skewing in favor of import of finished goods and actually punishing import of capital and intermediate goods. That is a very poor fiscal management tool. The second one is politically motivated monetary policy activity by the central bank, where it is all interested in singing praises about policy cuts. And when you ask, what do you want to achieve with your policy cut? He says inflation targeting. So you think the cedi depreciation is not causing inflation? When you have almost a lot of your imports coming for finished goods, okay, and then you now have a situation where your cedi is depreciating, what will happen to your inflation?
Of course, we are affected.
Exactly so. So what you are even doing is actually not supporting the inflation targeting objective that you want to achieve.
But I've heard the Bank of Ghana, specifically Sibo Pata, who say that the aim of the central bank with monetary policy is not really to look at the rate of inflation, what they call it, the rate of exchange rates, and look at the slight changes. No, specifically, it says what they're looking at is not the final figure. So they don't care if it's 5.24, 5.29, or even 6 cedis. What they really care is that the rate is stabilized over a period of time. So fluctuations, yes, they may make room for that, but they want stability over a period of time. So when the documents of the Bank of Ghana, especially the MPC's release stipulates that the cedi in the year 2017 actually depreciated by 4.9, 4.8%.
2017.
Yeah, 2017.
Yeah.
And in 2018,
8.8%.
it almost doubled to 8.8%. The expectation of the central bank is that going into this year, it will still hover around the 8%, which is not, according to the central bank, way out of the league of policy direction.
Let me explain. Let me say two things. Has Mr. Opata explained this to Dr. Mahmoud Bawumia? That that you don't really, you remember when this inflation thing came?
I get you, yeah.
I indicated that if depreciation is not a goal variable. I indicated that. It is not a goal variable, but it is a flexible tool for managing shocks to your economy, either from external or internal, through the currency. So when Dr. Bawumia was lambasting everybody for achieving a double-digit depreciation, what you were simply saying is that at the beginning of the year, we must set a target that we want a depreciation of a single digit.
Okay, yeah.
Are you getting it?
Yeah, that's
now, Opata is saying, what I'm saying is the truth, that depreciation is not a goal variable. So, Dr. Mahmoud Bawumia, where did you learn this goal variable depreciation?
Maybe, to be fair, I mean...
It is true that depreciation is not a goal variable.
Yeah, that's
an exchange rate. Have you ever heard? We say that we want to achieve a certain, what do you call it, inflation at the end of the year, or medium term, plus or minus 8%.
Yes.
Don't we have that?
That's
have you ever heard medium term depreciation figure?
No.
Have you ever had an annual target? That is why it is not a goal variable. And I kept saying that Dr. Bawumia politicizing this major tool that is available for managing shocks, okay, is disingenuous. And now Opata is confirming that it is indeed a flexible tool for managing shocks and not a goal variable. So has he been able to tell Dr. Bawumia this? He must tell him that he started all this issue of politicization. You see, now you see what has happened. We are now investigating what is the reserves at the central bank.
Yeah.
If you had not started the politicization, investors will not know that our dollars will finish in the next 1.5 months.
So that they can take out and convert and take out.
You get it? That is the reason nobody politicizes it. But Bawumia, the man who is now the vice president, set the tone for all of us to discuss what is and what is not about depreciation. And I'm now saying that now everybody knows that our reserve sitting at the central bank is so low that it can't support us for 1.5 months. So there's no dollars. What do you think if I'm an importer, what I will do? I'll go on the market and start looking for dollars now before they run out.
Well, we'll take a break. After the break, we'll continue our conversation. But looking into the future, now we basically understand what is the cost of our current state, at least from the Honorable Isaac Adongo's perspective, which is really what many people have actually referenced in this particular case. Where are the investors who are supposed to be investing in the economy? Why are they taking their monies outside of this economy, and all of the other factors we just discussed? After the break, we'll be looking at going into the future, what we should do differently. What does this say about the state of the Ghanaian economy, the fundamentals we have discussed over the period, and what are the reasonable, sustainable measures to make sure that we have not only a stabilized currency, but also our economy is on the right track? This is Upfront. You're welcome back. This is Upfront. My name is Raymond Akwa. So our conversation today is just settled on the cedi. I'm sure you have heard and you have also seen the trending Twitter hashtag that is actually saying, over to you, Bawumia, and you've seen the comments of people about the cedi. More importantly, though, is the impact of this particular rate of depreciation on the people who are doing business. We've actually chronicled on this network so many people who import, others who do trading, complaining about how this is going to affect their business, especially commencing the new year. We've also shown you that around this same time last year, there was an appreciation of around 1.52%, but this time around we are looking at 4.8% depreciation. That is what is the troubling trend, especially commencing the new year. Well, my guest, the Honorable Isaac Adongo, is with the Finance Committee of Parliament. Of course, he's a member of Parliament too, but some of the issues you raise, I'm given to understand the central bank would want to react to it, as and when we're able to reach out to them or we get them back on the phone line. we should be able to get their side to all of this. Of course, it ought to be stated clearly that the head of currency, right, the central bank, we've tried reaching him prior to this conversation to at least explain to us what is really happening on this network too. And we've not been very successful with that as we speak. So we should be able to get some more detail on that for us. So we can continue our conversation. So we have drilled down to basically what many have said are the causes and what you've also accentuated as the cause of our current state. The question that's on the minds of especially some of these importers is that, I mean, can the Bank of Ghana weather this storm, stabilize the situation with our current monetary situation?
Yes, that is my fear, and that is exactly what I have been preaching, that it is not about pumping your own hard-earned currency, the reserve, which is already depleting and exposing us to vulnerability to support the city. But you can engage in monetary activities that would attract more investment in foreign currency into our banks. And I gave the example of if you decide to up and provide an attractive interest rate, they will respond to your domestic issuance of bonds, and they will bring the dollars into your banks and take CDs from your banks to come and buy the bonds. In which case, you don't need to send dollars to the bank because the banks will not have dollars to trade, and that will improve liquidity. The second one is that it will also stop those who are reversing their investment to keep the monies here and rather decide to buy in the bonds and not also chase after the few dollars in the system. So there must be a monetary policy stand that clearly addresses this stress. And I'm saying that the politically motivated policy rate cuts is rather hurting the situation. And I am very strange. It's very strange.
But is that
the worst that could have happened?
Is that not in tandem with our inflation targeting policy? Is that not in tandem with that?
I am saying that we are import dependent on food, as we are seeing here, and that food is imported from outside. So if the exchange rate is poor and is depreciating, it will feed into your inflation because it will come in. When you convert it, it will be very expensive. They put their margins on it, and when you go to the market to survey prices, you will see that the prices are increasing. Whereas if you had encouraged these imports to come in, I mean these foreign exchange to come in, the market will be flooded with foreign currency. People will go to the banks and they will get their dollars. People will also come and buy your bonds, and in the end you will conserve the reserves that you have at the Bank of Ghana for a rainy day, when there are external shocks, when there are emergencies, when at some point in time the prices of commodities, and it is actually predicted that we may have a challenge with price of commodities this year. So if price of commodities drop so badly that our exports are not performing, okay, you will now have a route of now being able to use those buffers to support the currency. But you are engaging in a populist policy cuts. And when they ask you, you won't answer the questions. But I'm very happy that today he's listening to me. But he should know that I'm a good friend of him to be raising the red flags.
Okay,
for him to respond and deal with the red flags.
In your statement, forgive me, you made specific allegations of concealment and manipulation of net international reserves.
Yes.
One, you also moved to actually talk about specifically, and that this were manipulative policy rate cuts and policy distortions. Yes, that's the point you just raised. And some of these I want to put to, and I understand that on the phone line with us right now is the head of financial markets and treasury at the Bank of Ghana. Mr. Steve Opata, you're welcome.
Hello.
Yes, sir. If you can hear me, you're welcome. Thank you so much.
Thanks for having me.
I have questions of my own, but let me take your reaction first. Exactly what specific issues do you want to put in the right perspective?
Okay, thanks again. And I think I want to contribute to the discussion in relation to the adequacy of our international reserves. I think the Honorable Adongo has raised the issue that we stand at the risk of not having adequate reserves. And I think at the last Monetary Policy Committee meeting, we did state that we have 7 billion worth of reserves. Yeah. And in our estimation, that's about close to 3.7 months of import cover. There are many metrics you can use to measure this, but if you use the simple metric of monthly import cover, we so we have adequate reserves, but it's also important that we state that as a central bank, we are always looking for opportunities to build buffers, and that's what we're doing. We expect to build even more buffers to make sure that our reserves are not compromised.
Yes, briefly on that. Forgive me, and forgive me. This is distorting your thought. Forgive me, but you did state, of course, the MPC for January also said that there's been a decline from 7.6, which covers 4.3 months of import cover, at the end of December 2017 to 7 billion, which covered 3.7 months of import cover in 2018. I mean, you established the decline. That's not in doubt. Exactly. Which problem do you have with him repeating that? Sorry.
We're not disputing that there was a decline.
Yes.
The numbers you mentioned are correct.
Yeah.
But we have to set it in the context of what happened last year. Last year was a very tough year for a lot of emerging markets and frontier markets like ours, where a lot of external environments were not going in our favor. And I mentioned the Fed policy normalization. Fed was increasing its policy rate, and therefore making U.S. As a destination of investment more attractive. We have to fight that. Another thing was the geopolitical tensions we're facing with trade tensions, especially between U.S. and China.
Yeah.
This also had an effect on emerging markets such as ours. That's the second thing. So these things, combinations, led to some concern for investors. And it's not just Ghana, but you have markets such as Argentina, Turkey, all fighting pressure. So in the context of all of that, if we lost some reserves, yes, it's true we lost reserves, but I've just told you that we still, in our assessment after January, we still have 7 billion worth of reserves, which we believe that is adequate. 3.7 months of reserves is adequate, and there's no cause for concern.
Okay.
But more importantly, I've mentioned that we have strategies to rebuild reserves, and that's what a responsible central bank should do. I can assure Ghanaians that our reserves does not put the currency as risk as Honorable Adongo is putting. The currency level is determined by several factors. And
in a second, I'm sure we can go to these other factors. But I remember during our CD forum, which I moderated, I asked the question about what was our net international reserves at the time. You said you needed to cross-check. Now, can you tell us now what our net international reserves are? Because we know, and we've read from your report, the gross international reserves. Currently, what's our net international reserves, if can be said as of the end of December 2018?
Okay, thanks for that question. I'm just cross-checking for you our net international reserves.
Okay, so as we get my guest on the phone line now, forgive me a second.
Okay,
yes.
So after the January ending, we reported the net international reserves of $3.851 billion.
Sorry,
December,
give me a second.
December.
As of December 2018, you say what was the net international reserves?
3.851.
Is it 3.8?
3.851 billion US dollars.
Okay, so if I heard you right, you're saying $3.851 billion.
Yes.
And sorry, how many months cover specifically?
You know, when we talk about reserves, usually we don't articulate it in terms of net international reserves. The international best practice is to calculate your reserve adequacy in gross. So I'm not going to go that angle, but what I can tell you that...
But to be fair, doesn't the net give...
Most central banks is measured in terms of gross international reserves, and that I've told you is like 3.7 months of import cover.
I get you. Doesn't the net give us a better picture, a realistic picture of how much money really you have, not people's money?
We don't monitor months of import cover for net.
Okay. You don't?
We do it for gross.
Oh, okay. Well, that's interesting to know. Now, I need you to outline for me why we are seeing the level of depreciation of the cedi at this time as we are seeing it. Specifically, what are the factors?
Okay. So thank you for that. You know, we we entered 2019 with a number of factors playing out. The local last year we ended the CD at 4.82 to the dollar, 6.17 to the pound sterling, and 5.51 to the euro. So effectively, that represented an annual depreciation of 8.31% to the dollar. To the euro, we depreciated by to the pound sterling, we depreciated by 3.31%, and to the euro, 3.93%. So the city's performance in 2018, largely, as I've said, was influenced by external development, coupled with some domestic pressures, mainly from corporate and the energy sectors. Now, global risk sentiment so far have improved as a result of easing trade tensions between the U.S. and China. Mm-hmm. So we've seen some restoration of pressures in EM markets. On the domestic front, what I can tell you is that due to some gaps between the policy reference rate and the average interbank rate that we know, we have to do some adjustments in the way some correction in the way we calculate the reference rate. So this revision, what has happened is that we provide our reference rate to include all in banks or customers or corporate clients that are over $10,000 in the computation of the reference rate. Effective the middle of January, what we've done is to take out transactions that are done between Bank of Ghana and the banking system. And the reason why we did this was to address the gaps that are emerged between our reference rate to avoid what we call multiple currency practice. Now, It appears that the market, in responding to this correction, have maybe responded a little bit higher than we anticipated. But we think that this is something that will correct, and that's what we are working towards.
Okay, I get your point, but because my time is a bit limited, specifically, when are we going to see these issues you just raised resolved? What specifically is being done to resolve it? And when are we likely to see the stability of the city?
I can tell you that we're working on that. I've told you that our reserves are adequate, but we are working with strategies to even build more buffers. We feel that we're going to run appropriate monetary policy to address this, but also fiscal policy is also going to work appropriately.
I get you, so but when you say that we are going to run appropriate monetary policy, specifically, what are you referencing?
Okay, thank you. I think you just saw that we reduced our policy rate by 100 basis points, and that has been something that I think Honorable Adongo mentioned. But when we come to the Monetary Policy Committee, which I'm a member, look at several factors in making its policy decisions. We look at the real sector, we look at inflation outlook, we look at the external sector, and others, we consider even the banking sector. And when we look at all of this, and we look at it's a forward-looking approach.
Okay, I get your point. I get you. I want to specifically know how much are you pumping into the system in terms of dollars, and whether you're going to increase it or sustain it at this current rate. This is because I want to know when the current depreciation is going to come to an end.
Okay, thank you. Okay, so I've assured you that we have adequate reserves, but we're also coming out with strategies to make sure that reserve buffers are sufficient to provide liquidity as needed. But the levels of the currency are determined only by that. We have to run appropriate monetary policy, and we'll move as the numbers will show. We also expect to run fiscal policy that is well coordinated with our monetary policy. So those things should address it. So what I want to assure Ghanaians that economic management is on top, and these temporary
When? When do we see the change? When is this
I'm not going to give you a number, but what I can tell you is that
maybe a quarter. Would they exceed this quarter?
Don't worry.
Yes. Would they exceed this quarter?
And therefore, investors should still earn enough real returns to compensate them for their investment. And therefore, holding CD assets will continue to still remain attractive.
Oh, no, forgive me, Mr. Opata. The direct question I'm asking you is, when should the trader and the importer today, which date can you give them? Which period do you think this current depreciation situation is going to be over?
I mean, we're beginning to see some cooling off already, but I cannot give you a date. What I can assure you is that we're on top of this, and Daniel should not worry. The CD is going to recover at levels that are consistent with our economy fundamentals.
And I wish we could have more time, but unfortunately for me, I've run out of it. Thank you so much. I'm sure if you have time, maybe tomorrow or any of the other coming days, you could join us and have a fuller conversation on this.
That's fine.
Thank you so much.
I appreciate the opportunity.
I thank you so much too for joining us. Steve Opata is with the Bank of Ghana. He actually has been speaking a lot on the currency situation. Very useful commentary there. Reactions from you, Honorable, and I want you to do this in 2 minutes for me. Fortunately, I've run out of time.
He said a lot of things. You see, one, it is not true that we have not been measuring the net international reverse cover. Go through all the historical monetary policy, macroeconomic, and financial data that has been released. We actually measure. Why are they running away from measuring now? Because it is worse. You see, nobody measures your cover and is comfortable with your gross reserves. Nobody does. What you do, because the gross assets are not all available to Bank of Ghana to use. So if the government of Ghana has some loans to settle, and we have put some monies into a sinking fund and is sitting with you, can you go and use that money? What if you use it and the next day the creditor is there to take his money? What will you do? So they are not available to you. So forget this gross thing and let's focus on net. Okay, and I want to tell him that we've been measuring the import cover based on net, and the historical records are there. And now the second one is the almighty Federal Reserves of America is increasing interest rates. And you, a weaker economy, you are reducing interest rate. Does it make sense? And you expect that investors will come with all the good English.
Okay.
Please.
He said the situation will improve soon.
It will get worse. I'm telling you that the uncertainty is worse. But of course, I know his situation. Okay. He's supposed to manage the currency.
You said it will get worse. Why?
Because people are not too sure what will happen after April with the IMF exiting.
Okay.
And so the uncertainties from foreign investors waiting to take a decision on Ghana is getting worse. On top of that, you are now rubbing salt on their wounds by giving them unattractive rate. And when we talk, you speak good English. At the end of the day, let me ask you, all that he has said, you are quoting 4.98. Ask the investor whether he will be happy with him quoting 4.98, because the investor is not getting that one.
I'm privileged to have had you here today. Many thanks to you. The Honorable Isaac Adongo is a member of the Finance Committee of Parliament. You just heard, prior to this conversation, the Bank of Ghana's representative on that conversation there. Thank you so much, ladies and gentlemen, for joining us today's edition of Our Front.